Welcome to the Deep Dive. Today, we're tackling a giant, Amazon.
Yep, AMZN.
We've got this comprehensive investment research briefing as our main source.
Right. The DR 2250-517 PDF. Lots to unpack there.
Exactly. And our mission really is to cut through the noise, pull out the key insights about where Amazon is now, where it might be heading.
And what it all means for you, the listener.
Right. It's kind of amazing, isn't it? Their journey from just, selling books online.
To $1 trillion behemoth, touching everything. E-commerce, cloud, ads.
Even healthcare now. Okay, let's start with the big picture, the executive summary from the briefing. What jumped out at you initially?
Well, the first thing is this idea of wide moat, like a castle.
Yeah, it keeps competitors out.
Exactly.
Yeah.
And for Amazon, that moat comes from basically dominating e-commerce and cloud with AWS.
Right.
Plus, their digital advertising business is growing super fast. And they just have this culture of innovation built in. It gives them a real edge.
So really strong foundation. But it's not all smooth sailing, is it? The summary mentioned some headwinds.
No, definitely not. Near term, there are pressures on the retail side. Margins are tight.
Right.
And they're pouring money into future stuff. AI, healthcare, big investments.
Which weighs on profits now, but hopefully pays off later.
That's the idea. It's all about the long-term cash flow potential.
And where's the main engine for that cash flow right now? Is it still AWS?
Oh, absolutely. The briefing is crystal clear. AWS is the profit engine, big time.
Okay.
But what's interesting is that advertising is also getting increasingly profitable. Adds a nice second pillar.
And you mentioned cost control, too, under Andy Jassy.
Yeah, disciplined cost management seems to be a real focus for him, which, makes sense given the scale.
Right. He stepped into some massive shoes after Bezos.
Mm-hmm.
We should definitely circle back to that leadership transition later.
For sure.
So zooming out on the exec summary then, what's the sort of final word?
The overall vibe is positive for the long haul. They're riding these huge waves: cloud adoption, e-commerce growth, AI potential.
Okay.
So the investment stance leans towards a long-term buy or maybe a hold. But, and this is important, you've got to be aware of the risks.
Like regulation, competition.
Exactly. Regulation, intense competition, and just the sheer challenge of executing well at their scale. Those are the big ones to watch.
Okay, solid overview. Now, let's dig into the valuation. What does the briefing suggest Amazon is actually worth? What numbers are we seeing?
Right. Valuation. They look at it a few ways. One key method is the discounted cash flow, the DCF model.
Trying to figure out future cash value today.
Precisely. And that model points to an intrinsic value somewhere in the mid-230s per share.
Mid-230s.
Yeah.
Okay. Where's the stock trading now? Around $205?
Yeah, roughly $205. So the DCF suggests, maybe 10-15% upside potential.
Does the briefing cite specific DCF estimates?
It mentions stock up entry fee estimates around $236. So yeah, in that ballpark.
And how does that compare to, the average Wall Street analyst target?
Pretty close, actually. The Wall Street consensus target is hovering around $244, so broadly aligned.
So most models seem to think there's some room to grow from the current price.
Yeah.
What about comparing the current price tag to, Amazon's own history? Is it expensive now, historically speaking?
That's a good question. Right now, it's trading at about 33 times forward earnings.
Okay, 33x. Is that high or low for Amazon?
It's actually below its 5-year average, which was closer to 42x, so cheaper than it has been on that basis.
Interesting. What about other metrics, like EV to EBITDA?
Yeah, enterprise value to EBITDA, that's around 16.7x now. Again, that's quite a bit lower than its historical average, which was more like 25x.
So on a couple of key metrics, the valuation looks, less stretched than it used to be.
Exactly. It suggests the valuation is moderated somewhat.
Any other metrics worth noting? Price to sales, cash flow yield.
Price to sales is around 3.3x. That's actually pretty close to its 5-year average. And the adjusted free cash flow yield, it's around 2%. Looks low, but we need to talk about CapEx later that impacts free cash flow quite a bit right now.
Right, the heavy investments. Okay. The briefing probably considers different scenarios too, right? Like best case, worst case.
Oh, yeah. The what ifs. So in the bull case thing, strong revenue growth, like 15% plus per year, plus margin expansion.
Okay.
The valuation could potentially push towards, say, $280, maybe even $300 a share. Significant upside there.
Wow. Okay. And the flip side, the bear case.
On the flip side, the bear case, maybe growth really slows down, like single digits, or, regulators come down hard, force a breakup or something.
That's the big fear for some.
Right. In that scenario, The value could potentially drop towards the $150 to $180 range.
Quite a wide range between bull and bear. Highlights the uncertainty.
Definitely. Always uncertainty.
So, taking all these valuation points, the DCF, the historical multiples, the scenarios, what's the overall leaning from the briefing? Buy, sell, hold.
The general sentiment leans towards buy, especially for the long term.
Right.
They mentioned Morningstar's take, too. Morningstar has a fair value estimate of $240. That gets it a 4-star rating from them, which means they see it as undervalued.
4 stars, undervalued. Okay.
So yeah, putting it all together, the expectation seems to be for maybe 10–20% potential upside from current levels as profits get back to sort of a more normalized path.
Okay, that makes sense. Valuation suggests potential. But understanding that potential means looking at how they stack up against the competition. Let's pivot to strategic positioning. Cloud first, AWS versus Azure versus Google Cloud. AWS is the leader, but how big is the lead?
AWS still holds the biggest slice of the global cloud pie, roughly 32% market share.
Okay, 32%. Where are the others?
Microsoft Azure is number 2, around 23%, and Google Cloud is third, maybe 10–12%.
So AWS has a decent lead. What gives them that edge? Just being first.
Being the first mover was huge, definitely. But it's also the sheer breadth of services they offer now. Just tons of options. And their scale gives them economies, efficiency advantages. Plus, network effects, more customers attract more tools, attract more customers.
Hard to catch up with that. But the competition isn't exactly sleeping, right? Azure seems particularly aggressive.
Absolutely not sleeping. Azure is pushing hard, especially on the AI front. That partnership they have with OpenAI.
Yeah, ChatGPT creators.
Right. That's a big deal. It's helping them close the gap, particularly with businesses looking for integrated cloud and AI stuff.
Makes sense. Okay, let's switch gears to retail. Amazon dominates e-commerce, we know that. But how does it really compare to, say, a legacy giant like Walmart?
Right. So in U.S. online sales, Amazon is estimated to have around 38% market share. That's huge.
38%? Wow. And Walmart?
Walmart's online share is much smaller, maybe around 6%.
Big difference.
Yeah. Amazon's got the prime ecosystem, that massive selection, the logistics network. It's a powerful combo online.
But Walmart's fighting back differently, using their stores.
Exactly. Walmart's leveraging its huge physical footprint. Brick and mortar is their strength. They're pushing this omni-channel strategy, blending online and in-store, click and collect, using stores as fulfillment hubs.
Trying to bridge the gap.
Right. And it's important to remember, if you look at total retail sales, not just online, Walmart's overall revenue is actually still a bit higher than Amazon's.
Ah, interesting distinction. So different strengths, different battlegrounds. What about digital advertising? Another huge market. Amazon's a player, but Google and Meta are the titans there.
Yeah, Amazon's the number 3 player in digital ads. They pulled in around, $38 billion in ad revenue back in 2022.
Sounds big, but how does that compare?
It's still quite a bit behind Google. Google's like $225 billion, and also behind Meta, Facebook's parent.
Okay, so third place. What's Amazon's unique angle in ads?
Their secret sauce is the shopper data. They know what people are searching for and buying on their site. That allows for closed-loop advertising.
Meaning brands can see if the ad actually led to a sale on Amazon.
Exactly. Super valuable for advertisers. In the U.S., Amazon's ad share was maybe 14% in 2023, while Google had around 27%. So growing, but still behind the leaders.
It really feels like this diversification across e-commerce, cloud, ads.
Yeah.
That itself is a massive strategic advantage, doesn't it?
Oh, definitely. It's huge. They can cross-subsidize.
Meaning?
Like the profits from AWS and advertising can help fund lower prices or faster shipping in the retail business.
Yeah.
Keep the pressure on competitors.
Creates a powerful flywheel effect.
Precisely. And underpinning it all, according to the briefing, is still that relentless customer focus. That seems to be the glue holding the strategy together.
Okay, this gives us a great snapshot of where Amazon is today. But to really grasp where it might go, we kind of need to look back.
Yeah.
Let's dig into the history a bit, the founding vision. It all started with Jeff Bezos in '94, right?
That's right, 1994. And Bezos had this incredibly ambitious vision from day one. Earth's most customer-centric company.
He left a good job on Wall Street for this, didn't he? Saw the internet exploding.
Yeah, famously saw the stats on web usage growth like 2,300% a year or something crazy and decided he had to jump in. Used his regret minimization framework.
Ah, yes. Wouldn't regret trying and failing, but would regret not trying.
Exactly.
And they didn't start as the everything store. It was books first.
Just books. Launched July 95. Why books? Well, universal demand, huge existing category, but crucially, no physical store could stock everything. The web could.
Made sense as a starting point.
Uh,
And that customer focus was there from the beginning. Long-term thinking.
Absolutely. Prioritizing long-term growth, building customer loyalty over making quick profits. That day one philosophy started early. Obsess over the customer.
That day one idea seems core to their identity. Okay, so from online bookstore,
Yeah.
what were the really big inflection points? The game changers?
Several huge ones. Early 2000s, they launched Marketplace, letting third-party sellers onto the platform.
That was massive, wasn't it? Most items sold aren't even Amazon's own now.
Right. Something like 60% of units sold now are from third-party sellers. Totally transformed the selection. Then 2005 came Amazon Prime.
Prime changed everything for loyalty. Free 2-day shipping back then was revolutionary.
Totally. Now it's way more than shipping, of course. Over 200 million members globally. Huge loyalty driver, gets people spending more.
Definitely a game changer. What came next? They started building hardware too.
Yeah, the digital ecosystem push. Started with the Kindle e-reader in 2007. Basically created the modern ebook market overnight.
I remember that. Huge buzz.
Then came the Kindle Fire tablets, trying to compete with the iPad, and later, the Echo smart speakers with Alexa.
Getting Amazon into the home, driving more content and commerce.
Exactly, building that ecosystem. And then, of course, the really big one, kind of behind the scenes initially, AWS.
Amazon Web Services. Launched back in 2006.
Yep, 2006. They basically invented the modern cloud infrastructure as a service market, took their internal expertise and turned it into a business.
And now it's enormous. Over $100 billion in revenue. And hugely profitable.
Yeah, $108 billion run rate in 2024, and it's the main profit center, like we said. Absolutely transformative for Amazon and, frankly, for the whole tech industry.
It really is.
Yeah.
Beyond building things themselves, they've also bought a lot of companies, haven't they? Acquisitions seem key, too.
Oh, absolutely. Strategic acquisitions have been crucial. Early on, they bought Zappos for shoes, Audible for audiobooks,
Right.
Kiva Systems, which became Amazon Robotics. That was huge for automating their warehouses.
Made their fulfillment way more efficient.
Definitely. More recently, you've got Twitch for game streaming, Whole Foods for groceries.
Whole Foods was a big surprise.
Yeah.
Getting into physical retail in a massive way.
Huge move. Then Ring for smart home security, PillPack, and One Medical signaling their healthcare ambitions, MGM Studios for prime video content. It shows a pattern. Plant seeds, see what grows, double down on successes.
Quite a portfolio. Yeah. Okay, then the big leadership change in 2021. Bezos steps aside as CEO. What's his legacy, looking back?
Bezos' legacy, I mean, it's immense. Visionary risk-taking, that long-term perspective, the relentless customer obsession embedded in those 14 leadership principles.
A day one mentality.
Right. Avoiding complacency. Day two is death, as he put it. That demanding culture, the high standards, and the regret minimization framework that started it all, just a unique founder figure.
And he handed the CEO reins to Andy Jassy, who'd built AWS into a powerhouse. How did Bezos frame that transition? Was he confident?
Seemed very confident, praised Jassy's intelligence, high standards, track record, said he believed Jassy would embody Amazon's unique values and keep that special sauce going, a clear signal of continuity.
So Jassy takes over mid-2021. How has Amazon shifted, if at all, under his leadership? What's different?
Well, Jassy came in right as the pandemic boom was fading and the economy was getting choppy, so a big focus has been on streamlining operations, getting costs under control after that massive expansion.
We saw layoffs, some store closures.
Exactly. Workforce reduction of about 27,000, pulling back on some experiments like the physical bookstores, the Scout robot, more focus on efficiency.
But still investing in the big things.
Oh, yeah. Doubling down on AI, cloud infrastructure, the core growth engines. He talks a lot about continuing the day one principles, but maybe with a bit more operational discipline, pragmatism.
So execution-focused, cost-conscious, but still trying to maintain that innovative spirit. A balancing act.
Seems like it. Navigating a more mature, more scrutinized Amazon while still chasing those big bets.
Okay, that sets the stage nicely. Let's dive into the nitty-gritty now, the business model itself, the different segments. The briefing breaks it into 7.
Yeah, 7 main buckets for analysis. Online, retail their own sales, third-party seller services, the marketplace, AWS cloud, advertising, subscription services, think Prime, physical stores, mostly Whole Foods, and then this other emerging category for stuff like health and devices.
Got it. Let's start with the original core. Online retail, first-party sales. How big is that now, and what's its role today?
Still huge in revenue terms. $247 billion in 2024. That's about 39% of their total sales.
Still the biggest single chunk.
Yeah, But growth has slowed there, and
Yeah.
it's notoriously low margin, lots of competition, high fulfillment costs.
So why keep doing it at such scale?
It's the customer acquisition engine. It pulls people into the ecosystem, gets them hooked on the convenience, the selection. Then maybe they sign up for Prime, buy from third-party sellers, use other services. It feeds the whole machine, even if the direct profit on, say, a book sale is small. North American retail margins did improve recently, though, hit 8% in 2024, which is pretty good for them.
Ah, okay. So it's the anchor. What about the third-party seller services, the marketplace? That's grown massively.
Hugely. $156 billion in revenue in 2024, so about 24% of the total. And it's been growing fast, like 15% compound annual growth rate recently.
And presumably much better margins.
Much better. Amazon collects fees and commissions, takes a cut, but doesn't have to buy or hold the inventory. Less risk, higher margin. Plus, that network effect we talked about, more sellers attract more buyers, which attracts more sellers, the virtuous cycle.
Makes sense. Okay, on to the powerhouse. AWS, cloud computing. What are the key stats there?
AWS hit $100.6 billion in revenue in 2024. That's about 17% of Amazon's total sales. Strong growth, too, up 19% year over year.
And the profit contribution.
That's the kicker. Over $36 billion in operating income. That was around 54% more than half of Amazon's entire operating profit. It's the cash cow.
Wow. Still dominant market share, around 32%.
Yep. Competition's fierce, like we said, with Azure and Google Cloud. And growth did moderate a bit as companies optimized spending, but it seems to be reaccelerating now.
High margins too, right?
Very high. Operating margins expanded to around 37% in 2024. Though those massive investments in AI infrastructure might put some pressure on that number near term, they need the capacity. Long runway, though, most IT spending is still on-premise, maybe 90%.
Huge potential still. Okay, advertising. Another standout performer recently. What's driving that?
Ad services generated $56.2 billion in 2024. That's 9% of total sales, but growing fast, around 20% year over year.
Why is it so attractive to advertisers?
Because the ads are right there next to the products when people are ready to buy. High intent. Advertisers see clear ROI, linking ad spend directly to sales on the platform.
That closed loop thing again.
Exactly. And it's thought to be very high margin. Puts Amazon firmly in that digital ad triopoly with Google and Meta. Leveraging all that first-party shopper data is key.
What's next for ads? More video.
Yeah, growth drivers include more video ads like on Prime Video or Twitch, and expanding their reach so brands can advertise off Amazon using Amazon's data. Risks are balancing ads with user experience and maybe an economic slowdown hitting ad spend.
Got it. Subscription services next, mainly Prime memberships. What's the role there?
Subscriptions brought in $44.4 billion in 2024, about 7% of total revenue, growing around 10% year over year. Prime is absolutely central to loyalty.
Keeps people locked in, spending more.
Definitely. Over 200 million members worldwide. They shop more often, buy across more categories. The membership fee itself might not be pure profit, given the costs of shipping and video content, but it drives so much other profitable activity. It makes the whole ecosystem stickier. Risks are market saturation eventually, and competition from Walmart plus Book.
Okay, physical stores, mostly Whole Foods. What's the strategy behind keeping that physical presence? It seems kind of low margin compared to the others.
It is lower margin, generated $21.2 billion in 2024, only about 3% of total sales, growing maybe 4%. Mostly Whole Foods.
Some, why bother?
It's about that omni-channel play, serving customers who still want to shop in person, especially for groceries, tapping into that massive grocery market. Plus, it offers options like online order pickup, returns, blending the physical and digital.
Have their other store concepts worked out, like Amazon Go?
Mixed results, really. They've closed some formats, still experimenting. It's tough managing physical stores, thin margins, intense competition.
Okay, last bucket, other or emerging segments. Healthcare, devices. What's going on there?
Smaller slice, $5.4 billion revenue in 2024. Healthcare includes Amazon Pharmacy, One Medical. They're making moves, trying to disrupt, but it's still pretty early days. Nascent effort.
Devices?
Yeah.
Echo, Ring? Are they big profit makers?
Probably not directly from the hardware sales. Devices like Echo, Ring, Fire TV are more about enabling the ecosystem, making it sticky, driving engagement with Alexa, Prime Video, shopping. They involve significant R&D costs, too.
So hardware as a gateway to services.
Pretty much. And this segment also covers big AI investments like the Alexa large language model, warehouse automation, competing with Apple, Google in these spaces.
It really feels like all these segments are woven together, the cross-subsidization you mentioned earlier.
Exactly. The briefing stresses that interdependence. AWS profits fuel retail investments and Prime benefits. Ad revenue helps pay for the platform. Prime bundles everything together. It's designed as a self-reinforcing flywheel.
But each part has its own risks and margin pressures too, right?
For sure. Retail faces inflation, labor costs, unionization efforts. AWS deals with pricing pressure from competitors' huge CapEx needs. Advertising is sensitive to the economy, privacy rules, and regulation, especially antitrust, hangs over everything.
But overall margins have been improving recently.
Yeah, 2023 and 2024 saw overall margin improvement, largely thanks to AWS and ads becoming bigger parts of the mix, plus those cost-cutting efforts.
Okay, that paints a really detailed picture of the business itself. Let's zoom back out a bit and talk about leadership and governance. We touched on Bezos versus Jassy. Can you elaborate on the differences in their styles and vision as the briefing sees it?
Sure. Bezos was the quintessential visionary founder. Big, bold, long-term bets, even at the expense of short-term profit. High standards, customer obsession, that working backwards from the customer need process, varied, demanding, aggressive capital allocator.
And
Jassy brings deep operational chops from building AWS. He's seen as ensuring continuity of the culture, but with maybe a more streamlined, pragmatic approach. More data-driven, perhaps. He's navigating a much larger, more complex, and more scrutinized Amazon.
Has that difference shown up in how they allocate capital or set strategy?
Seems like it. Jassy's continued investing heavily in the core areas, AWS, AI, but we've also seen him pull back quicker on things not working, like those physical bookstores, the Scout robot. More focus on, what's delivering results now or has a clear path.
More disciplined, maybe.
Perhaps, and definitely focused on navigating that post-pandemic transition, including the cost cuts and layoffs, which was a bit different from the constant growth narrative under Bezos, but still expressing confidence in the long-term opportunities.
What about the board? How does governance work at Amazon? Is it aligned with shareholders? Bezos is still executive chairman.
Right. Yeah, Bezos is still exec chair, so he still has influence. But the board itself is pretty diverse, lots of experienced people. Crucially, Amazon doesn't have that dual-class stock structure that gives founders total control.
That's generally seen as more shareholder-friendly.
Right. The board seems supportive of the long-term approach. They've overseen the recent start of share buybacks, which is a bit of a shift for Amazon returning capital instead of reinvesting every penny. They have a tough job overseeing such a complex company facing so much public scrutiny.
Innovation is obviously key. How does Amazon keep that engine running? And how does Jassy fit into that?
They've really tried to bake innovation into the culture, things like the 2 pizza teams to keep things small and agile, internal incubation processes, and a tolerance for failure. Experiment patiently, accept failures.
Bezos talked about that a lot.
Yeah, Jassy's expected to continue that. I mean, look at the innovation that came out of AWS under his leadership. They're still making big bets, generative AI, Kuiper satellite internet, Zoox autonomous vehicles. Seems like the innovation pipeline is still flowing.
What about succession planning? Jassy himself came from inside. Is that the model?
Seems to be. Strong focus on internal promotion. They clearly identified Jassy early on. The board's likely looking hard at the next layer of leaders in AWS, retail, etc.
Could they ever split the CEO role, given how huge Amazon is?
Some people speculate about that, especially if they ever spun off AWS or something major, but that's just speculation for now. The focus seems to be on developing internal talent who get the culture. Jassy's appointment itself is seen as a successful transition so far.
And how has communication with shareholders changed under Jassy?
He still writes the big annual shareholder letter like Bezos did. That's important. But one noticeable shift, Jassy actually joins the quarterly earnings calls with analysts now.
Bezos rarely did that, right?
Very rarely. So it's a bit more traditional Wall Street engagement, maybe reflects Amazon maturing into this mega cap staple, balancing its unique culture with, broader investor expectations.
Okay, super helpful context on leadership. Let's switch back to the numbers. Financial performance and valuation, focusing on maybe 2020 through 2025 projections. How's revenue growth looked?
Revenue growth has been strong overall. about a 13% compound annual growth rate over the last 5 years. Hit $638 billion in 2024.
Obviously saw a big bump during the pandemic.
Huge surge in 2020-21. Then things decelerated a bit in 2022 as the world reopened, but growth bounced back pretty well in 2023 and 2024. Importantly, the mix is shifting towards those higher margin segments like AWS and ads.
What about profitability? Operating income, net income? Seemed a bit volatile.
Yeah, definitely some swings. 2022 saw a dip, costs went up, plus they had that big loss on their Rivian investment way on net income.
Right.
But profitability rebounded strongly in 2023 and hit records in 2024. Operating income was $68.6 billion, net income $59.3 billion.
So that net income had a boost.
Yeah, big gain from their investment in Anthropic, the AI company. But even adjusting for that, the underlying profit trend was sharply up.
Let's look at the key profit metrics for 2024. Operating margin, net margin, ROIC.
Operating margin hit 10.8%. That was the highest it's been since 2018. Shows the cost efforts and mix shift are working.
Okay, 10.8%. That's pretty solid.
Net margin was 9.3%. And return on invested capital, ROIC, was estimated around 21%. That's a strong number, suggests they're creating good value from their investments.
Good to see ROIC improving. Now, cash flow, always critical. How's that looking? Operating cash flow, free cash flow.
Operating cash flow, OCF, is super strong. $115.9 billion in the trailing 12 months ending Q1 2025. A real cash machine.
Okay, OCF looks great, but free cash flow.
Free cash flow, FCF, is much lower right now. $25.9 billion for the same period. The difference is capital expenditure, CapEx.
The heavy spending on AWS and AI infrastructure we talked about.
Exactly. CapEx surged to $93.1 billion in that period, nearly double the year before. And they're signaling it'll stay elevated through 2025, mainly for AWS and AI capacity builds. That eats into FCF in the near term. Balance sheet is strong, though.
Right, investing for future growth. Okay, let's revisit valuation multiples quickly. Current versus historical. Just recap the key ones.
Sure. Forward PE, around 33x, below the 5-year average of 42x. EV/EBITDA, around 17x, also below its historical average of 25x. Price sales, 3.3x. That one's near its historical median.
And the cash flow multiples.
EV/FCF looks distorted because of that high CapEx right now, but price operating cash flow is healthier, maybe around 20x, which is also below its 5-year average. So valuation seems less demanding than it has been historically.
What's the general feeling on Wall Street now? Still bullish?
Overwhelmingly bullish, based on analyst ratings. Something like 47 out of 50 analysts covering the stock have buy ratings.
Wow, strong consensus.
Yeah. Average price target around $244, suggesting decent upside, lots of confidence in the growth story and the margin improvement narrative.
And compared to competitors, is Amazon's valuation reasonable versus, say, Microsoft or Walmart or cloud pure plays?
Seems reasonable in context. Its forward PE isn't wildly different from Microsoft's, even though Microsoft has higher margins, currently suggesting the market expects strong growth from Amazon. It's obviously much higher than traditional retailers like Walmart, but they have much lower growth.
What about versus cloud companies?
Pure-play cloud companies often trade at much higher price-to-sales multiples. So you could argue the AWS part of Amazon looks relatively cheap on that basis, though it's bundled in the conglomerate. Some of the parts analyses generally support or even exceed the current market cap.
Okay. One more thing on financials.
Yeah.
Operating leverage. Are they getting more efficient as they grow?
Looks like it, especially in 2024. They showed good operating leverage. Operating income grew much faster than revenue. Cost of sales came down as a percentage of revenue. Fulfillment costs stabilized. Tech and content spending is still high, but they're squeezing more profit out of each dollar of sales. That improving ROIC points to better capital efficiency, too.
So summarizing the financial outlook from the briefing,
The outlook seems pretty positive, expecting continued solid revenue growth, maybe 10-12% a year, but operating income could grow faster, maybe 15-20% annually, thanks to that leverage and mix shift. Consensus EPS for 2025 is around $6.50, a big jump from 2024. Valuation looks reasonable for the quality and growth.
great financial picture. Okay, let's pull back again to the competitive landscape and strategy. We hit the pieces, but maybe a SWOT analysis helps consolidate. Strengths, weaknesses, opportunities, threats.
Yeah, the briefing does a SWOT. Strengths are pretty clear. The brand, the scale, AWS leadership, the Prime ecosystem, tech prowess, strong cash flow from AWS.
Weaknesses.
Retail margins are the big one.
Yeah.
Reliance on third-party sellers needs careful management, and the massive regulatory target on their back.
Opportunities.
Huge ones. International expansion, growing advertising further, new verticals like healthcare, B2B e-commerce, Kuiper, Zoox, lots of optionality. AI is obviously a massive opportunity across the board. Strategic acquisitions, intense competition everywhere, cloud, retail ads. Regulatory crackdowns remain the biggest cloud hanging over them, cybersecurity risks, and just the macroeconomy, a big slowdown would hurt.
Okay, let's revisit the competitive benchmarking one more time, maybe layer in some strategic nuances. AWS versus Azure versus Google Cloud. What's the strategic battleground now? Is it just price?
Price is always a factor, but it's increasingly about capabilities, especially AI integration. AWS plays on its breadth of services, maturity, reliability. Azure leverages the Microsoft ecosystem, enterprise relationships, and that OpenAI partnership is a huge strategic asset right now. Google Cloud pushes its strengths in data analytics, AML, and multi-cloud hybrid solutions. It's a features and ecosystem war as much as a price war. Who can help businesses modernize and leverage AI most effectively?
Retail. Amazon versus Walmart. Beyond online versus physical, what are the strategic moves? Walmart Plus versus Prime. Marketplace competition.
Yeah, Walmart Plus is their answer to Prime, trying to build loyalty. Walmart's also building its own third-party marketplace, trying to replicate some of Amazon's success there. Amazon, meanwhile, is trying to improve its physical presence, effectiveness, Whole Foods integration, maybe new grocery formats, using stores for logistics. It's about closing the gaps in each other's armor. Groceries remain a huge battleground.
Advertising. Amazon versus Google versus Meta. How are they differentiating? Is Amazon just taking search ad share from Google?
Amazon is definitely leveraging that point of purchase advantage. Its strength is in sponsored product ads. It is likely taking some retail-focused search ad budget from Google. Google's fighting back by integrating more shopping features into search and YouTube. Meta is trying to improve its on-platform shopping tools. Amazon's pushing into video, Prime Video, Twitch, Freevee, and off-site advertising to broaden its reach beyond just Amazon.com product ads.
It really highlights how Amazon's diversification lets it fight on so many fronts, using strengths from one area to bolster another.
Exactly. That cross-subsidization and the flywheel effect are central, but it also means they face best-in-class competitors in almost every segment. They can't afford to slip up anywhere. The scale and data are huge advantages, but also attract that intense scrutiny. Execution is key.
Absolutely. Okay, let's bring it right up to date. The briefing likely covers the most recent earnings, right? Q1 2025. What were the key takeaways and strategic signals from that quarter?
Yeah, Q1 2025 results were pretty solid. Top line, net sales hit $155.7 billion. That was up 9% year over year, beat estimates slightly.
How did the key segments perform? AWS ads.
AWS growth reaccelerated nicely, up 17% year over year. That was a positive sign for cloud spending stabilizing or picking back up. Advertising also stayed strong, up around 21%, both key engines firing well.
And profitability. You mentioned improvements earlier. Did that continue in Q1?
It did. Operating income was very strong, $18.4 billion. That's an 11.8% operating margin, up 20% year over year, beat their own guidance.
Wow, 11.8% margin. Where did that come from?
AWS margin was particularly strong, hit 39.3%. But retail margins improved too, both North America and international. All segments were profitable, shows those cost efficiencies are really kicking in. Net income was $17.1 billion or 1.59 per share, though that included an investment gain. Adjusted EPS was maybe around $1.28, still up like 30% year over year, strong bottom line performance.
What about cash flow and that heavy CapEx spending in Q1?
Operating cash flow still robust, $113.9 billion on a trailing 12-month basis, up 15%. But free cash flow still depressed by CapEx. Q1 CapEx alone was $16.3 billion.
And they're guiding for more spending.
Yep. Said full year 2025 CapEx would be higher than 2024, still mostly for AWS and AI infrastructure builds, investing heavily to capture that future demand. They see a huge wave coming with AI.
Any other strategic nuggets from the Q1 caller report? Anything about AI adoption, advertising trends, retail?
Yeah, a few interesting points. They said AI workloads on AWS are growing over 100% year over year, huge demand. Admitted some near-term AI capacity constraints, but expect that to ease later in 2025. Advertising strengths continued. On retail, they said higher grocery costs weren't really slowing down sales much. Talked about expanding Buy with Prime and their third-party logistics services.
What about costs and margins looking ahead?
They guided for some margin pressure in Q2 due to investments, specifically mentioning Project Kuiper satellite costs ramping up, but also highlighted ongoing cost savings from regionalizing their fulfillment network. International profits improving. Oh, and an interesting comment about maybe seeing some consumer pre-buying ahead of potential tariff increases. Regulatory stuff was just background noise on the call.
And how did the market react to all this Q1 news?
Initial reaction was positive. Stock popped a bit after the report, like the AWS reacceleration and the strong profits. Some of that faded with broader market jitters, but overall, it seemed to reinforce the positive narrative.
Okay, Q1 paints a picture of solid execution and continued heavy investment. Let's bring it all home now. Final critical evaluation and investment recommendation based on this deep dive into the briefing. It landed on a buy rating, right? For long-term folks.
That's right. The bottom line was a BUI rating, but specifically emphasizing a long-term perspective. They see it as compelling due to those growth catalysts, the competitive moats, and the improving financials. But they also caution about the volatility and risks. It's not a slam dunk. Needs careful consideration of position sizing.
What are the top, say, 3 to 5 long-term growth catalysts the briefing really hammered home?
Okay, number 1, AWS leadership, especially capturing the massive AI wave. Potential for growth to reaccelerate there is huge.
Right. Cloud and AI.
Number 2, advertising. Just tons of runway left to grow that high-margin business both on and off Amazon's platform. Monetizing e-commerce better.
Go ads.
Number 3, the subscription ecosystem. Prime keeps getting stickier, adding value, growing that customer lifetime value.
Prime loyalty.
Number 4, emerging verticals. Healthcare, Kuiper, Zoox. These are like call options on huge future markets. Even if only 1 or 2 hit big, it's significant upside. Optionality.
You aren't tears.
And number 5, operating leverage and shareholder returns. As they gain efficiency and FCF grows, expect more buybacks, maybe even a dividend someday, returning cash to shareholders.
Yeah, those are compelling. But the risks. What are the top 3 downside risks that investors really need to watch?
Number 1, unquestionably, is regulation and antitrust. Governments globally are scrutinizing them. Fines, forced changes, even breakup risk. It's the big unknown.
Regulatory sword of Damocles.
Pretty much. Number 2, macroeconomic slowdown. A deep recession would hit consumer spending, retail, and business spending. AWS. Very cyclical exposure there.
Macro risk.
And number 3, competition and execution. Rivals like Microsoft, Walmart, Google aren't standing still. Amazon needs to keep innovating and executing flawlessly, or they could lose ground. Mishaps are costly at their scale.
Intense competition, plus other risks like FX, inflation, labor, ESG stuff.
Exactly. Those are always factors, too.
Did the briefing lay out specific price targets for those bull, base, and bear scenarios we discussed earlier?
Yeah, roughly. Bull case potential up towards $280, $300, maybe higher, driven by strong growth and margin expansion. Base case, the most likely, aligns with current Wall Street targets, maybe mid-$240, assuming steady progress. Bear case, if things go wrong with macro regulation, could see it dip towards $150, $180, maybe even lower in a severe scenario, though they see that as less probable.
So wrapping it all up, the final recommendation is buy for the long haul. What's the core rationale in a nutshell?
Core rationale: strong fundamentals, riding powerful secular trends, cloud, e-commerce, AI, proven ability to adapt and innovate. Valuation is reasonable, not dirt cheap, but fair for the growth profile and quality. Expect outperformance over 5+ years, but definitely be prepared for volatility along the way due to those risks.
Okay. Well, this has been an incredibly thorough deep dive into Amazon, really mining that research briefing. So to summarize the key takeaways for you, our listener, Amazon's this incredibly complex beast with powerful growth drivers, e-commerce, AWS, advertising. It holds strong competitive positions, but faces intense competition and, that ever-present regulatory shadow.
Right. And profitability is definitely improving, driven by AWS and ads and those cost controls Jassy put in place. They're investing heavily, especially in AI, which impacts near-term cash flow. But the long-term outlook still looks pretty bright, according to this analysis.
Absolutely.
And, as Amazon keeps weaving itself deeper into our lives, cloud, shopping, entertainment, maybe healthcare next, it makes you wonder, doesn't it? What's the next totally unexpected area they're going to disrupt? And what does that mean for all of us?
That is a fascinating thought to chew on. We definitely encourage you to explore the sources further and keep watching the Amazon story unfold. It's certainly never boring. Thanks so much for joining us for this deep dive.